On the Express this week, shake, rattle, and roll. Volatility is back just in time for October. The bull market celebrates a birthday. What's behind the debasement trade that everyone's talking about? Barry Ritholtz, the OG blogfather, drops in for a few good minutes to talk about his book, why we should care about the bankruptcy of an auto parts company, the Investopedia indicator, and what to watch this week. Microphone check 1, 2. What is this? It's the Investopedia Express, and it's time for business. Welcome back and welcome aboard. Happy Monday. It is a holiday here in the U.S. It is Indigenous Peoples Day and Italian American Heritage Day, but the stock market is open and it is bouncing back after some tough losses last Friday. Boy, we haven't seen a screen of red like we did last Friday in a very long time. And for a minute there, it looked like things were starting to fall apart here. It was the worst day last week to end the week since so-called Liberation Day on April 2nd, on the heels of the president announcing new tariffs against China, 100% increase in tariffs above and beyond the 30% that are already in place. Why? It's all about those rare earths. China not wanting or adding a tax onto those rare earth minerals and pretty much a lot of the other products they export to every single country, import-export taxes that it does business with. The president responding with 100% tariffs, he said, would go into place on November 1st, and that rattled the markets. You see there that sea of red? Wow, that really sent some of the biggest stocks out for a spin-off, and it gave us a clear signal that for a moment there, for just a hot minute, risk was off. That's right. There goes your little Pac-Man there. But you know what? Stocks are bouncing back today because cooler heads have prevailed, at least for the moment. And that's sort of been the pattern with this tariff negotiations, the on-off. Is it going to happen? Is it not going to happen? Are we going to negotiate? Are we not going to negotiate? At the end of the day, markets have trudged higher, but we did have a little volatility, and it's just in time for October. And we saw some of the biggest stocks in the market take a big hit last week, especially the semiconductor stocks. They're right in the middle of this battle between rare earths coming out of China and semiconductor exports coming out of the U.S. China needs our semis. We need their rare earth minerals to make those semiconductors, and that's where we are. But as Jimmy Cliff likes to say, the harder they come, the harder they fall. Big stocks taking big hits last week, and the NASDAQ dropping 3.5%, but bouncing back a little bit this week. And you know, when Jimmy Cliff is singing, he's talking about the biggest stocks in the market, the NVIDIAs of the world, the Microsofts, and the others that are right in the middle of the AI build out, and the biggest stocks in the market that you all own and love the most, according to our sentiment survey. Those took a hit. But it did interrupt a 33-day streak of really low volatility in the stock market. I mean, the volatility in the stock market's been gone for quite a while right now. We've been getting it with Liberation Day, but that was the first day in about 33 days where we've seen a 1% move outside of the normal trading range of the S&P 500. Tells you how quiet things have been. 33 days in a row, according to our buddies Ryan Carson and Sonia Vargas, Ryan Dietrich and Sonis at Carson Group there. We hadn't had volatility, and it's back. But is it back just in time for October? Is this just October being October? Or is this just tariff turmoil? Hey, don't forget, October has brought some historically scary days to the stock markets. The scariest month in the stock market. And I'll take you back in history to the panic of 1907, back in October 1907. Huge run on the banks. Everybody was concerned that their money in the banks was not guaranteed, and it wasn't at that time. Huge bank run. Dow Jones Industrials, wasn't that many stocks at the time, fell 50%. This led to the creation of the Federal Reserve in 1913, the Federal Reserve Act in 1914, but it also kicked off a couple of years of pretty intense selling pressure and a pretty rough time for the economy. But that was nothing compared to what happened in 1929. How about that? You had Black Monday, you had Black Tuesday, you had Black Thursday, you had pretty much several years of pain. After a huge collapse in margin debt, Dow Jones fell 25% in just a few days. Back then, it was a very big deal. In 1929, it fell 89% from 1929 to 1932, and was part of a huge depression that lasted for the better part of a decade. So another scary event in the month of October. And then you got to go back to 1987, Black Monday, 1987. This was sort of the beginning of program trading. There was a lot of concerns about overvaluation and speculation and irrational exuberance in the market. Dow Jones fell 22.6% in one day. Biggest one-day decline for the Dow Jones Industrials in history until this day. And that prompted reforms in market circuit breakers. And now the market has certain circuit breakers. If you go down to the stock exchange over the NASDAQ, when the market falls a certain percentage, they put in what they call circuit breakers. That triggers circuit breakers. It allows the flow of sell orders to come through, right, in an orderly basis. It wasn't happening back then. We were just moving to decimalization, but that really caused some major reforms in the stock market. And now there's a little bit more control when we have a sell-off, but we haven't had one of those in a very long time, maybe since April, but still not of that magnitude. And we haven't seen circuit breakers really in the stock market kind of since the pandemic, but October can be a pretty rough month. But hey, let's not talk about that. Let's talk about the bull market celebrating its third birthday on October 12th. Happy birthday. 3 years, October 12th, that's when the market actually was recovering from a 25% decline. And again, with our friends at Carson Research who do such a great job with the charts here, bull markets that make it to their third birthday usually do pretty well after that. There's only been about 6 of them in the past 50 years that have made it that far, and they do pretty well. But let me give you some historical context from our good friend Sam Stovall over at CFRA Research. Since World War II, the 8 bull markets that reached a third birthday lasted nearly 6.5 years on average with 213% gains. Not saying it's going to happen this time, but the current bull market is up 89% through its October 8 peak. And that suggests that maybe it has some room to grow. Now, there are some headwinds, of course, and there always are headwinds. This is the highest 12-month PE ratio right now for the S&P 500 since World War II, according to Sam Stovall. And plus, we have elections coming up, midterm elections, and those always give us a little rocky road in the market, so to speak. But usually after midterm elections, according to CFRA, the market's pretty resilient, rises around 6.5%. Now, don't go investing, I should say, around elections and midterm elections. Just know historically we get some volatility as we go into midterms, and we'll probably get some volatility if this bull market goes on to its 4th birthday, because there's so much going on out there in the world. But that is the historical context we are in. Happy birthday, bull. Happy 3rd birthday. We hope you make it to 4, 5, 6 years old. All right, let's get some wisdom from the original blog father, a guy that I have learned and so many investors have learned so much from over the past few years. Let's bring in Barry Ritholtz in the drop-in.
Hey,
you like that?
I do. The drop-in. There are no skate parks near me, so.
Well, that's a tragedy, and we're going to have to fix that. We're going to make the Ritholtz skate park one day out there on Long Island. Thanks so much for joining the Express, Barry. Again, I've learned so much from you. I consider you a friend, and you've taught so many of us so much over the past few decades, being the original blogger, the original blog father who was out there with the Big Picture blog over, 30 years ago. One of the first people outside of business journalists like me and my friends to actually start writing about the markets and interpreting it. Welcome to the show, my friend.
Well, thank you so much for having me, Caleb. I'm thrilled to be here.
You are out with a terrific new book that I'm just taking apart, How Not to Invest. You don't see books with a title like this very often. You got this going. You got the Masters in Business, tremendous podcast on Bloomberg, The Big Picture still. You've been putting some work into that. But why'd you write this terrific book, How Not to Invest? Why'd you title it this way?
I really didn't want to write another book. I had people kind of saying, hey, it's been a couple of years since Bailout Nation. How about another book? And the honest answer was just simply, hey, there have been tens of thousands of books telling people how to invest. And everybody is still a pretty mediocre investor. Why do we need yet another one? And over a holiday break, I started just putting ideas on all these 3x5 cards and posting them on my giant bulletin board. Normally, I'm very digital, but I don't know, it just felt like this was a thing to do manually. And it became pretty clear pretty soon, gee, I spend a lot of time debunking investing nonsense. Can we curse on the show? Debunking a lot of BS. And I started organizing them on the board, and pretty soon it was clear 3 broad categories of things that I do wrong and every other investor does wrong. And hey, maybe there's a lesson to be had. Instead of telling people what to do, tell them what not to do. Avoid the bad ideas, steer clear of the misleading numbers, And then most importantly of all, don't engage in the behaviors that destroy wealth. And so when I pitched the idea to the publisher that was kind of haranguing me to write another book, well, first, debunking investing bullshit didn't fly. They're like, oh, no, they're proper British editors, so that was no good. But then the second idea, how not to invest, hey, it's kind of fundamental. Don't use a negative in a title. And I'm like, why not? Well, people think it's bad. Well, it is bad. You want to avoid the bad. So we ended up with this title. I kind of came up with the idea for the cover by tell you what, let's put how to invest in bright letters and kind of hide not in a different typeface off to the side, but have the same color for not be a stock line crashing. And they took that idea and turned it into this beautiful cover. And I couldn't be happier working with Harriman House. They've been a blast.
Yeah, they published some great books, including our friends Heather and Doug have a book with them. We know so many good authors with them, but a lot of folks who might not know you from what your actual day job is, you founded a wealth management firm, an RIA, a very successful one. I'm a full disclosure client, and nobody would think that somebody who's in the business like you, who folks like you kind of are known for talking their book, don't do that. You're telling people what not to do. And you've been telling people what it is, like it really is, since you really began this journey. And there's a through line from your original blog, The Big Picture, I think it was called, out there on GeoCities way back in the day, all the way through thousands of those into Bailout Nation, into how not to invest, even into what you do in Masters in Business, where you're explaining how things really work. Why did you choose that track? Why did it appeal to you?
I had no choice. I have very little internal filter, and if something is really annoying me, I talk about it. So in GeoCities, I was kind of back in 1998 and 99, I was kind of gassed about all the negativity, really ever since Greenspan's 1996 irrational exuberance speech. Hey, when was the last time a Federal Reserve chair called the top in the markets? Markets tend to go further and longer than anyone expects. Fair value is just this moment that we pass on the way up and on the way down, but you're only there for an instant. Most of the time, markets are either cheap or overvalued. And so I started writing about that speech. The blog moved over to TypePad in 2003 and then WordPress in 2008. And then really the predecessor to the podcast began in 2010, 2011. I had folks like Felix Zuloff and Ned Davis come on and talk about what they did. And I had been writing in the Washington Post when Bloomberg solicited me to write a column and offered me a TV show. I'm like, instead of a TV show, why don't we just have an adult long form conversation with intelligent, accomplished people and find out who they are and how they got that way? That's much more interesting to me than what was ISM today? Why should I care? Is this really significant? And so that was the birth of the podcast back in 2013. And it's really, I don't know, I wouldn't be, I don't have a great memory, so I wouldn't be able to keep all the BS straight. I just found it easier to say, here's my philosophy. Here are people that I think are steering you wrong, and here's the way to navigate that. And as you know, the ideas in the book are how we manage the firm. It's how we do things. We spend a lot of time managing behavior, teaching people what matters. I want to say half these chapters in the book all began with a question from a client or an investor. Hey, I know you've said XYZ, but this guy is saying this. Why should I not pay attention to this? And what started out as a simple blog post would eventually become a podcast, and that eventually became a full chapter of the highlights. And here's why you don't want to pay too much attention to most forecasters. And here's Philip Tetlock, and his books explain why the average expert forecaster is no better than anybody else. And here's ways to make better forecasts by understanding what is and isn't predictable, and little things like that. It's so funny, an innocent little question turns into, a whole throughput.
Yeah, and that is the beauty of investing, because we're always continuing to learn. And the book's broken up into 4 parts, basically: bad ideas, which includes bad advice, prediction Inc. You like to call it, and prediction
Yep.
Inc. is what we're all surrounded by if we work in finance or we work on Wall Street, we work in business media, guilty as charged here. The media, of course, talking about the majority of what we say, you say, is irrelevant to our portfolios, and it actually is. Part two, bad numbers, which is, what are you actually paying attention to? What numbers are you paying attention to? Three, bad behavior, which is what you just talked about, our animal spirits getting the best of us. And then part four, which is good advice, what you actually should be paying attention to. So I love the breakup there. When you talk about good advice, what are you talking about? Who should we be listening to? Why should we be listening to them, or reading, or watching?
Ironically, the good advice is the shortest section of the book. It's maybe 10% of the book. So let's talk about who we should be paying attention to, who you should be listening to. And a lot of this today is so relevant because people literally pay attention to nonsense they see on social media. It doesn't matter if it's LinkedIn or X or Blue Sky or Instagram, or perhaps worst of all, TikTok. There's this wonderful Twitter thread called TikTok Investors, a wonderful account, and he highlights the worst advice given on TikTok. So that became a chapter in the book. When I was researching that, the advice given about not just investing, but anything financial, taxes, it turns out the TikTok tax advice was so terrible that the IRS had to put out a 42-point memorandum saying, here are 42 items we found on TikTok telling you here's some tax advice. Not only are these wrong, some of them will lead to fines, some of them will lead to penalties, and some of them will literally lead to jail time. Get your tax advice from an accountant, not from TikTok. So that's just an example of how egregious some of the terrible, terrible advice out there has been. And so the counter to that is, don't take candy from strangers. Understand. My mom told me that many, many years ago, and it's amazing. You have to go back to principles that your parents gave you. If you're going to pay attention to someone on TV and print, on radio, on social media, well, at the very least, you have to know, who are they? What's their track record? Are they more right than wrong? Do they have a process, or did they just get lucky once? Do they have a good temperament? Meaning, every 5% pulled out back, do they run around with their hair on fire, or are they sort of have the right sort of calming influence to not stimulate you to do something bad? And have they been around long enough? Have they seen a few cycles? Do they know how the movie ends? Those sort of questions are how you put together what I call an all-star team. You don't even have to hire them. You just have to follow their Substacks or their websites or their podcasts when you put a team together. I put a list of a dozen or so folks that are my A-team all-stars, plus all the people in my firm I think are really all-stars. And, it's different for every person. Find somebody who's done this for a while, who's got a good track record, who doesn't inflame your passions, be it FOMO or panic, and have seen how this plays out over the fullness of time. I made that one list of 12. There are probably a few hundred people that could be in my top 10 list. You could do all sorts of variations, but of the tens of thousands of people who tweet, blog, podcast, write, whatever, most of them aren't worthy of your time. And that's just an unfortunate truth about Sturgeon's law. He said it about writing, but it's true about everything. 90% of most products are crap. The best of the best, the top 10%, is where you want to focus. And it's true whether you're buying a SPAC or an ETF or a hedge fund or signing up for someone's Substack.
Absolutely. Happy to say we've had a lot of those experts on the Investopedia Express, probably because I've been following you for years and I read who you read, and then I teach people about that. And then that's how hopefully this education cycle goes on, because that's what we're trying to do, get smarter about the markets. Talking about, people who've had a track record and investing through cycles and knowing the cycles. I love this chart that comes from your firm, for Michael, our buddy Michael Batnick, reasons to sell. And there have been nothing but reasons to sell throughout investing history. I love this chart because he keeps adding to it. It gets uglier and uglier because there's more and more reasons to sell. Yet there's this relentless bid. And I've talked to Josh Brown, the CEO of Ritholtz, and a friend of ours as well, a good friend of mine, and obviously your partner there, about this relentless bid. The fact that we just keep buying every couple of weeks. We just keep putting money into our 401ks, our Roth IRAs, our IRAs, because that's what we were told to do. And actually, it's proven to be the right thing to do. So do you think that this is just this force of nature that just continues forever, Barry? What eventually might make it stop, if anything? Or are we just conditioned to do this now, just like we're conditioned to pay our utility bill?
Nothing lasts forever. Even the sun is going to burn out in 5 or 6 billion years. But just think of the compounding between now and then. But every bull market ends, every cycle turns, every economic expansion ends with a recession, every bull market ends with a bear market. And, I love to, humans are just, we are so stuck in the here and now. We sometimes have a hard time pulling ourselves out of the moment and looking at the fullness of history. Batnick has another chart, a similar always a reason to sell, but it goes back to like 1926. And there have been world wars and the fear of nuclear Armageddon and on and on. There's always a reason to sell. Look, the World War II ended, and then from 1946 to 1966, you had an amazing 20-year run. That ended for a variety of reasons, and from 66 to 82, market went up and down and made no forward progress. The Dow was just about 1,066. It was just about 1,082. Add in inflation, you lost 75% of your value over that 16-year period. And then from 82 to 2000, you're up 1,000%. It's just a huge run. And then again, the wheel turns 2000 to 2013, up, down, up, down. You have the financial crisis in 08, 09, just like the Nifty 50 crash in 73, 74. And then when we finally get over all those previous highs of that trading range from 2000 to 2013, we're off to a new bull market. So here we are 12 years later in a market that can end in 2032. It can end tomorrow. Nobody really knows when it comes to an end. The real wild card to me is I have no idea what the 34% crash during the pandemic and then the biggest fiscal stimulus since 1946, at least as a percentage of GDP. CARES Act 1 under Trump 1 was 10% of GDP, huge number. Another big chunk of CARES Act 2 under Trump 1. Biden CARES Act 3, and then the infrastructure bill. And now Trump 2, we have another giant tax cut. I can't tell you when this bull market's going to end. I suspect it's not tomorrow, but it's somewhere out there, 3 years, 5 years, 7 years. And so you end up with a situation that all bull markets run further, higher, and longer than anyone expects. And that's what we learn every cycle. Go back to the 1996 irrational exuberance speech and go back to the early 60s and see how people were investing. And those bull markets just continue to go year after year, and they end much later than we have any reasonable expectation to see.
Yeah, and the bear markets seem to be shorter and shorter. At least that's what we've experienced over the last couple of decades, probably because of the fiscal stimulus, government helicopters money everywhere. And when you got money pouring in from the skies from the government, hey, it's easy to see why markets can recover so quickly. All right, if you were 35, though, right now, kind of knowing what you know, would you be investing the same way that you invest today? I mean, you're a little older than 35 right now, just a minute older or two. But if you were a 35-year-old, we have a lot of younger folks who listen to the Express. How would you invest? Would you be an index investor, an ETF investor?
So go back 25, 30 years. Yes, I would be an index investor. I would be more fastidious about dollar cost averaging every month, which I was less disciplined with in my 20s and 30s and even early 40s. It took took to the mid 40s before I'm like, hey, I'm not around forever. I better start saving for retirement. And then something I really started doing in my 40s and 50s, I wish I would have started doing earlier, which was I have a lot of friends that have done startups. I have a lot of friends that have come up with great ideas. And really, I'm not a venture capitalist. I'm not an angel investor. My approach to startups is, hey, is how big of a vote of confidence do you want to put into this person? How much do you think that I don't care what they're doing? I just think that I love the way they think. I love the way they approach the world. And I think that'll be successful. So I want to throw money at these people. To be fair, in my 20s and 30s, I didn't have a lot of money to throw at people. Today, there are folks like Eric Golden at Canopy and the folks at Altruist. And, there's a dozen small startups where I love what these people are doing. I love how they think. I want to participate in whatever they're doing, whether it's this or something else. So let me write a check. And so I wish I would have been more aware of the value of that. My friend Howard Lindzen taught me that it doesn't matter how big the check is. You don't have to put $1 million into a startup. If you give someone $25,000 or $10,000, it's the money, yes, but it's also, hey, man, this is a vote of confidence. I really think that you're onto something. And if it's not this, it's something else. Here's a check. Go do your thing. So I wish I would have been more aware of the power of that. Not so much that, hey, there's money to be made, but you need to let the people around you who you are so impressed, enamored, and just taken by their thoughtfulness, their philosophy. You just want to give them a vote of confidence, regardless. I had somebody, and I won't name drop, but somebody who's really well known said to me, hey, 12 years ago, you were really encouraging about this project when a lot of people were negative, and you said, hey, you're onto something, keep plowing away. It's going to be a rough go, but you'll make it. You just, like, I was shocked this person said this to me. And I wish I would have done more of that. I didn't know how important and influential just those attaboys are. It doesn't matter who the person is or what the area is. When you recognize talent, when you recognize insight, don't be stingy with your compliments.
Yeah. Well, shout out to Howard Lindzen, who one of the smarter investors we know, but Howard has taught all of us, follow the pilot fish, right? You may not get to the shark, but follow the pilot fish who are following the big sharks, and you will wind up in the right places. And I think you may have not had the money to invest in people's businesses, but you have made a great investment in people. And you can see your disciples literally throughout financial media, throughout wealth management and other places. So don't sell yourself short on that. All right, let's get you out of here on a couple of quick lightning round questions that I'm dying to know. I got to know what you're reading right now, Barry. What's on the Kindle? What's on the iPad? What's on your Libby app? What are you reading right at this moment?
2 books I'm reading right now. One is Breakneck by Dan Wang, which is about the rise of China and how China is a country of engineers. The U.S. is a country of lawyers. They're building things. We're stopping things. There are lessons that each country can learn from the other. And then the other book is the reissue of The Winner's Curse by Dick Thaler, which he revisited with a colleague, Alex, I'm drawing a blank on his last name. And they see how, this is the 25, 30 years ago, they see how his original theses, what he calls anomalies, held up. And it's really a fascinating behavioral finance book.
All right, putting those on the next on my next list, my wish list for books. Best finance book overall. You've written a couple of tremendous ones, including How Not to Invest. But so what's your favorite finance book? Could be novel, could be historical fiction, could be actual nonfiction.
So Thinking Fast and Slow is so seminal to me. And the one before that was the original Market Wizards, which is all about risk management and behavior management, non-investing. And then the idea of Moneyball, the idea that you can look at a field and recognize where everybody is missing the through line is just fascinating. And we've seen Moneyball time and time again. We've seen it in The Big Short. We've seen it in the response to the pandemic, and we've seen it in AI. So many people just miss the picture because it's such an anathema to the previous experience.
Yeah, Michael Lewis so good at finding that story and turning it into something amazing. So on the heels of that, a lot of those turned into incredible movies. What is your favorite money movie, Barry Ritholtz?
So The Big Short is certainly up there. And then while everybody was focused, the book, The Big Short, Moneyball is even better than The Big Short. But while everybody was focused on things like the Big Short, there was a movie that came out right after the financial crisis, and I'm drawing a blank on the name right now. Give me 10 seconds to find it. Margin Call. Thank you so much. I love Margin Call. I love
that movie too.
I think it's kind of underrated. And then, of course, The Wolf of Wall Street is just a spectacular film on a mediocre book. But, Martin Scorsese and Leonardo DiCaprio, tough to beat that film.
Yeah, tough. All right, let's go on this last one. If you were going into college or coming out of college or going to major in something in college today, if you were going to college at all, what would you study?
Well, I would definitely go to college. I'm not a big fan of the skip college movement. There's a handful of outliers that works for, but for 99% of the public, you're better off going to college. It's an opportunity to learn everything. What I've learned in 30 years in finance is you have to be as broad as you are deep, and you can't just be hyper-focused in finance. Most of the really insightful, interesting wisdom you pick up often isn't from finance, but it's from adjacent fields. So I would do a combination of some form of behavioral economics or psychology with philosophy as like a concentration. And if you want to study business, if you want to get an economics degree or an MBA, fine, but recognize that all the great advances and insights come from outside of that narrow area.
Yeah, great point. Great point. We have a question here from Kojo. What would your book recommendation be for a beginner investor? Great question. What do you got for him, Barry?
I mean, there are some classics everybody should read. I really like Bull by Maggie Mahar, The History of the Bull Market from 82 to 2000. It just shows you so much about how cycles develop, how they extend, what happens with behavior and psychology and investor. Like the 82 to 2000 era was just such a classic. And then the crash at the end, that's a great one. Everybody likes Reminiscences of a Stock Operator, and I'm a fan of that, but it wouldn't be the first book I suggest. And then Where Are the Customer's Yachts, or just another one of these hilarious books that, again, they describe the entirety of investing and not just here's how to asset allocate, here's how to rebalance the portfolio. It's much fuller than that.
Yeah. So many good choices there. Random Walk Down Wall Street. We have a great list on Investopedia. And hey, folks, if you're following Barry Ritholtz at Ritholtz, you'll probably see all his recommendations from many, many years of making us smarter about investing, making us smarter about finance, and also how to operate like a good human being in this world that we all operate in. Barry Ritholtz, the founder of Ritholtz Wealth Management, the author of this tremendous new book, How Not to Invest, plus a couple other books, and also the host of Masters in Business on Bloomberg. So good to see you. Thanks for joining the Express, my friend.
Oh, thank you so much for having me. Always a pleasure, Caleb.
All right, so good. Let's get to a little money in motion, because there's a lot going on out there that we're starting to pay attention to, giving us some signals. Let's do a little money in motion. We're starting to hear an old term make some new headlines, and it's called the debasement trade. And this has been around for a long time, but this is starting to bubble to the top of the headlines across the Wall Street Journal, the Guardian, and other places. But you're starting to see this as gold rises to record highs, while other assets like oil are not necessarily are heading in the other direction. This flock to gold, keeping it at record highs, has got people talking about the debasement trade. Let's get to what the actual word means: debasement. Debasement, according to our friends at Merriam-Webster, this is the action of reducing the quality or value of something. So when you think about debasement and the debasement trade happening right now, we're actually talking about this flock to safety assets like gold in particular. And this classic example that Bank of America Securities and the research team pointed out there: 15 barrels of oil. I think we have a chart for this. 15 barrels of oil bought 1 ounce of gold back in June of 2022. You got to look at the gold versus oil ratio to see the classic example of debasement trade. Now it literally takes 61 barrels of oil to buy 1 ounce of gold. Now, as Warren Buffett says, hey, gold's a good safe haven asset, but if you buy an ounce of gold today, it's still an ounce of gold at the end of the day. Now, the price can go up, but it doesn't compound over time. But when you see this concern about global economy, when you can see the concern about inflation and the stock market, meanwhile, bubbling over to record highs over here, but on the other side of the seesaw, investors, including the Federal Reserve and central banks around the world, flocking to gold, this tells you that there is a debasement trade going on, and people are concerned about what's going to happen next. And that's something we need to pay attention to as we look towards the end of the year. Let's look down the tracks just to this week, because even though today might be a holiday, except for the stock market, there is a lot happening down the tracks. Let's look at what to expect this week. We are in the teeth, I should say, of earnings season, getting into it real hot and heavy here this week and going on for the next few weeks. And earnings expectations are pretty sky high. According to FactSet, our buddies over at FactSet, earnings growth for the quarter is expected to be about 8%. That would be the 9th consecutive quarter-over-quarter consecutive earnings growth. It just tells you what investors are counting on, right? That's what we're here for. We are betting on earnings growth. We are investing in earnings growth and some dividends. And dividends have been on the rise too, according to S&P Global Insights. We're starting to get some dividend paybacks as well. They decreased for a little while there over the past couple of years, but they are back on the rise. But earnings growth is expected to be solid. The strongest sectors should be IT, then financials. Even with interest rates heading lower, the net interest margins for some of these banks, and the fact that there's a lot more activity, more IPOs, more mergers and acquisitions, more investing, more assets to invest in, good for financials. They should have a pretty strong wind at their back when it comes to earnings. And then materials, utilities, and industrials. If we are indeed going to keep growing and we don't end up ruining this growth, this progress with trade wars, well, we could see a good rally and a good earnings growth in materials, utilities, and industrials. And if you look at the stock market, we've seen some pretty good strength across all of those sectors. All right, let's get into what else is happening this week, because it's a busy one. Again, stock market's open today. Bond market's closed. Always rare when that happens. But usually you get some pretty thin trading in the stock market. We got the Oracle AI World Conference beginning this week. They're going to be talking all about AI. We do have some earnings from Fastenal. Tuesday, we get the NFIB Small Business Optimism Index. Small businesses, like consumers, not feeling that optimistic lately. A lot of concern over tariffs, a lot of concern over those small packages from China or from around the world that they're getting that really make up the essence of their small business. A lot of order flow there. Salesforce, the Dreamforce conference begins this week, and then big bank earnings begin on Tuesday with JP Morgan, among others, Goldman Sachs, BlackRock, Citigroup, Wells Fargo reporting on Tuesday. Wednesday, we get the Federal Reserve Beige Book, which is actually red. That's sort of the Fed's latest roundup of economic activity around the country. The Empire State Manufacturing Survey for October comes out. Earnings from ASML, Bank of America, Morgan Stanley, Abbott Labs, United Airlines, and others. Thursday, home builder confidence. Not so confident lately, but as rates come down, you're going to see a lot more activity in the housing market. Maybe that wakes things up a little bit, and plenty more earnings in store on Thursday as well. And then Friday, hey, we're missing some economic reports, and we're probably not going to get them. But on Friday, we should be getting industrial production and capacity utilization. We might not. Earnings from American Express, among other companies. So a busy week for earnings. Earnings expectations are sky high. Here we go, off to the races. Pay attention to Investopedia and our news team. We are following the earnings that matter the most and breaking down the stories that matter the most to you within those earnings. All right, let's get to our indicator of the week. And this one comes from a very strange sector. This comes from the automotive supply sector and a company called First Brands. Now, you may not have heard of First Brands, and but you've probably heard of a lot of the portfolio companies within First Brands, companies that sell windshield wiper blades, companies that sell headlights, companies that sell different auto supply parts that you might find in your AutoZone, for example, or your Midas. This company has accumulated all of these assets as a conglomerate, kind of like the Berkshire Hathaway of the auto parts industry. But this company filed for bankruptcy back in September. And nothing crazy about an auto parts supplier filing for bankruptcy. But when you get into the weeds on this, and the Wall Street Journal and others have done a great job breaking this down. I saw a good story in the Guardian on this. It's more than just the fact that this company filed for bankruptcy. It's the fact that it had such steep losses, liabilities between $10 billion and $50 billion on its book, but assets only between $1 billion and $10 billion. But this company was doing a lot of what we call opaque off balance sheet financing. In other words, it was borrowing heavily, according to the journal, using private debt, or what we call shadow banking. When you hear the word shadow banking, you should immediately put up your guard. Disguised debt, and they disguise that debt by borrowing against invoices. This is known as factoring. Again, not crazy in the auto parts supply or any industrial supply industry to do what we call factoring, but the borrowing and the leverage was so high that when the company eventually got too over leveraged and business wasn't that great, it had to file for bankruptcy. It turned the company basically into a finance company. So it was selling auto parts and running all these nice companies, these small, medium-sized enterprises, and all of a sudden it turned itself into a finance company, started factoring its invoices, and when the bottom dropped, so did the entire company. So this could be one of those canary in the coal mine type stories. What other companies are out there using shadow banking, using this type of factoring in the middle of a boom right now? And as Jim Chanos, the great legendary hedge fund manager, pointed out back in the day, he's the one who pointed out Enron before Enron became the Enron collapse. He says, complex financial systems often appear at the end of economic booms. As long as everything works, nobody's asking questions, but people are going to start asking questions about companies like Fast Brands. All right, let's go out with some good news and a shout out to those Nobel Prize winners. We got the Nobel Prize in Economics awarded earlier today out in Switzerland right now. And big shout out to Joel Moyker, Philip Aghion, and Peter Howitt. They've received the Sverigis Riksbank Prize in Economic Sciences in memory of Alfred Nobel for this year. This is about their work in explaining how innovation and what economists call creative destruction drives economic growth. So the Nobel organization said these three economists had helped deepen the understanding of the drivers of the pickup in economic growth over the past 2 centuries to levels that are high and relatively stable by historical standards. Congrats to you three on winning the Nobel Prize in Economics. That's a pretty big deal. And thanks to all of you for joining us from around the world. Thanks to Barry Ritholtz of Ritholtz Wealth Management. The Big Picture, How Not to Invest. We'll link to the book in the show notes. Thank you for joining. Hey, Supervisor Dan, thank you. Yeah, great. Barry's a great interview. And if you're not listening to Masters in Business and you like that type of stuff, he is a tremendous interviewer, such a great host. He is just as candid and fun as he is to talk to here. Thank you, Kojo. Very insightful of you to point that out. We appreciate you. Thank you, Wall Street Stocks. Very cool. Thank you for joining us today. Thanks to all y'all for tuning in. We know it's a federal holiday here in the United States, but a lot of us are getting that work done. We're on the grind, and the Investopedia Express will be back with you next Monday live at 10 a.m., but it is on demand on your favorite podcast network. So if you missed the full live show, you know where to find us. We'll put links to Barry's book and all the good stuff we cited in the show notes when this goes up in just a little bit. And whatever you're doing, keep it safe, and we will talk again a little further on down the line.